G'day guys, it's Nathan here. Today we're going to delve into the escalating demand for homes, dwindling listings, and what this means for both buyers and sellers with an increasing competitive market. In the last 3 months leading up to May, home sales have outstripped new listings. This indicates there's a sustained buyer's momentum, and this is all despite interest rates continuing to rise. National sales reflected 78,000 homes changing hands. This is in comparison to a modest 68,000 new listings added to the market. This discrepancy points to a sales to listing ratio of 1.15 based on CoreLogic's data. And if you do find value in this video, please consider hitting that subscribe button, as it does really help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. The figures clearly indicate that demand for housing currently exceeds the supply of new listings. This trend is in stark contrast to the sluggish housing market that we've seen in the later half of the previous year. Interestingly, the sales to new listings ratio maintained a sturdy level, even amidst a market downturn. The combined capital cities ratio rarely fell below 1. A ratio exceeding 1 suggests that the market is favorable to sellers, as there's competition amongst buyers which intensifies with tightening inventory. Consequently, sellers are less likely to reduce their asking price. A separate study conducted by Suburb Trends saw that out of 328 examined areas, 219 experienced a similar trend of demand surpassing supply. This despite the likelihood of future interest rate hikes. A significant number of potential sellers remain uncertain about their next move, which caused a rippling effect with low listing volumes. This in turn stabilizes prices and suggests that several Sydney markets had rebounded from the downturn, with conditions strengthening consistently. In Sydney, the inner south, inner west, eastern suburbs and Sutherland demonstrated a high absorption rate. Similarly, houses in Melbourne's inner east, inner south, outer east saw swift sales as well. For instance, around 77% of average monthly listings in Maverick District were sold within a 30-day period. Absorption rate, a percentage signifying how fast a home is sold, is considered beneficial for sellers when it's above 20%, indicating rapid sales due to high demand. Conversely, a low absorption rate, less than 15 to 20%, suggests more relaxed market that could potentially offer lower prices due to the abundance of choices. Despite the looming prospect of higher interest rates, buyer demand continues to hold strong. On average, auction events attract 6 active bidders, 5 of whom typically miss out. This demonstrates a substantial buyer presence in the market. Melbourne's Glen Eira district achieved the highest national absorption rate at 80%. This translates to 90 out of the average 112 homes listed each month being sold. Low stock is fueling the high absorption rate. Active buyers in the market are feeling the heat of competition, and despite the cost of mortgages rising with each rate rise, buyers are feeling like they're being outpaced by the market. And this scenario is especially true for those who experienced the price growth that we all saw in 2020 and 2021, and they understand the implications of waiting for the market to cool down, where prices might actually continue to climb. In the wake of a dozen consecutive interest rate hikes since the previous year, many home buyers are facing significantly higher mortgage repayments. This can be a challenge, especially for those who are living on a tight budget and already stretched with their financial limits. If you're experiencing this burden, you're not alone, and it's important to remember there is help out there. Here are some steps you can take if you're struggling to keep up with your mortgage repayments. The first piece of advice is to take action early. Reaching out to your lender as soon as you suspect you might not be able to meet your commitments or having difficulties with your increased repayments is a proactive step to prevent a negative mark on your credit score, and also provides you with options of potential financial relief. One option you could do is negotiate for a better deal with your bank. Try and ask your current lender for a lower rate, or consider refinancing to another lender. However, if you've already tried to refinance without success and you're finding it hard to keep up with your repayments, this is a clear sign that you need to take action protection. For those needing more personalized assistance, your lender might be able to help you with financial hardship options, and banks and financial institutions typically have specialized teams for assisting customers who are struggling to make ends meet. Information on how to access these services can often be found on the lender's website. If you prefer independent advice, there are third-party services such as the National Debt Helpline that connect you with financial counselors. This can provide you with a comprehensive review of your financial situation and help devise a plan that suits your individual circumstances. Once you reach out for help, there are several ways your lender might be able to assist you. They might suggest reducing your repayment by reducing your loan to an interest-only repayment or extending your loan term out over a longer period of time. Alternatively, if you're going through a temporary financial difficulty, your lender might arrange for you to have a short-term change to your loan, such as a repayment holiday. However, remember, these changes will likely require a reassessment of your loan affordability, and if your mortgage is relatively new, the bulk of your monthly repayments may already be going towards interest, which means switching to an interest-only loan might not result in significant savings. Also, when you switch to an interest-only loan, it does mean you're going to pay more interest over the life of the loan, so you need to be careful before making these decisions. If you're unable to make your payment, it's important not to panic. Typically, you have a grace period after missing a payment before the lender leaves marks or defaults on your credit file. Use this time wisely to communicate with the lender, establish a payment plan, and seek financial counseling. A missed payment can impact your credit score, but this can be mitigated if you arrange a hardship agreement with your lender. Though this might appear on your credit history for years, it can reflect positively if you meet your repayments under the arrangement. A default payment, however, can negatively impact your credit score for 2 years, which might hamper your ability to refinance or secure new credit. Once again, it's important to talk to your lender here. Understand what they're going to be doing, how this is going to implement and affect your credit file and your ability to secure finance, because the last thing you want to do is get into an arrangement with your lender, but then that gets left on your credit file, which prevents you from being able to refinance in the future. In some cases, selling your property might be the most viable option. While this usually is considered as the last resort, it may be necessary if you're unable to meet your financial obligations, and it's unlikely that your situation will improve in the near future. If this is the case, selling your property can often yield a better price and prevent less fees, such as legal fees associated if the bank were to seize and sell your property for you. Regardless of the path you choose, it's essential to remember that you're not alone, and there's many resources available to assist you during these challenging times. So reach out with your lender or the National Debt Helpline for help. You're certainly not alone. It's definitely something that you need to do. Keep your communications open. That's the most important thing. Guys, here at Hunter Galloway, we are mortgage brokers. We deal with people Australia-wide. So if you are needing assistance with finance, you're more than welcome to reach out. There's no cost for our service. And our details to get in touch are huntergalloway.com.au, where you can visit our website, we can fill in a contact form, or call us directly on 1300 088 065. Guys, as always, thanks for watching, and we'll see you next time.